I am very fortunate to have with me a good friend, Alex Gdulski, one of the harder working men in the business. Alex, welcome to the Debt Doctor.
Thanks, Bill. I appreciate it.
You know, when we first met, gosh, I gotta say, one of the things that, and we'll get into what you do, and it's a broad range of services to the mortgage and real estate industry. I'll give you a minute. In a minute, I'll give you a moment to kind of speak to that. But I just have to say, there are very few people who, over the 10 or 15 years that I've been in this business, have really earned your spot in the business as a respectable kind of staple. I mean, I remember when you were just a young data pusher. I want to say,
Still young, Bill. Still young.
yeah, still young. And it was literally like, how do I provide a better service, cheaper, quicker, and easier to use to the guys like me who are out there? Well, tell everyone, give everyone a little bit of background about.
Yeah. So a short history. I have a master's in electrical engineering. Spent years with AT&T Bell Labs. 9 patents there. Worked as an architect on some of the cell phones. Remember those Motorola flip phones, Razor?
Oh
That
yeah,
was
my
mine.
favorite.
That was mine. Nokia, Samsung. So all of those, Ericsson cell phones had my chips in it. Everything
Wow.
was great, but one time I went to this Russian spa. You know when they hit you with the leaves? Yeah. So one of those things.
Yeah.
And then a few business guys got together and we started to brag about where we are in life. And one of the guys said, "Well, I have no education, but I'm making tons of money." And he says, "Well, do you want to know how much am I making?" I said, "Sure." He said, $3 million a year. To me, yeah, I thought I was making a lot, $150,000 at the time. It was phenomenal money. Not enough. Came crying to my wife, and she says, "I believe in you. Go do your stuff." So if he can do it, you can do it. So that's my history on how I got started. As still a young data pusher, as you said, but from that point on, it was just a lot of hard work, a lot of coffee.
Yeah.
Um,
Just think
yeah,
about.
yeah. And I'm a CEO of 3 companies, and I guess 50% owner of JV. The sort of bigger, well-recognized brand name on the market is ProTitleUSA, which is a text and title due diligence and analytics provider, which is very unique from a regular title company. I'm not a title company.
Right.
The second company I acquired in 2021 called DocSolutionUSA, doc prep and recording firm, and we're ripping out all the old technology and putting the new technology in, AI-based. And the third company is a fun company that I spend 90% of the time with, babysitting it because it's so much fun. It's the fully rated CPR firm, third party due diligence firm called One Diligence. And that is the company that looks at the loan files, underwrites, spits out securitization reports, and we just set a brand new record. We can touch on that as well. But certainly that's 90% of my time is spent with that company. And I have a JV with a company called Rocktop Technologies, who is really rebranding from a multi-billion acquirer of RPLs and NPLs. And since that market dried up, it rebranded to the technology firm. It's rocktop.io, I believe, or rocktech.io. And we now have a JV partnership in some of the AI products that we're launching. So a lot of fun, a lot of companies, not enough coffee during the day. So that's my story.
Too many cups of coffee for me during the day. And yes, I don't know how you do it. I mean, it's enough of a feat to go out and create one successful firm that provides services to the mortgage, banking, and real estate industry. But to go off and create three and to do so where each one, I mean, it kind of makes sense though, because each one kind of complemented each other along the way.
That's right.
Going back to the original Pro Title, when was it that you found it? I don't even remember how long ago we
Yeah,
met.
the idea was in 2007. I started in 2008, and the idea was absolutely a disastrous one. I completely failed in thinking. I thought that I'm the smart guy that can think two steps ahead of me. Remember GFC and when the banks failed and a lot of foreclosures are on
Yep.
the market and tons of activity at the auctions, and I thought, hey, let me start a title research company because I really used one and I hated it. It cost me $20,000 worth of losses. I said, I can do things better. Let me get educated, and I started that pro title company in 2008 with the idea of selling the title reports at the steps of the court auctions.
Oh, I didn't know that was the original plan.
I was so wrong. It's everybody had their own diligence a week before the auction.
For
They knew
sure.
which properties they want to buy, and I was standing there stupid, with the papers for every property. And I said, well, that didn't work right. So, and then that caused an evolution of my thinking. How can we create such a report, such an analytics for the capital markets, for them not to even look at the single page of the documents. And that was the original idea that sort of evolved from my failed idea to really focus on analytics rather than title work, right? So we wanted to be a company that it doesn't matter where the title search is coming from, even Puerto Rico in Spanish, we wanted to convert that to English and analyze it and then spit out the report where a Wall Street banker would look at it and say, oh, I know what position of the lien I'm in, what liens attach, what's the status on taxes. So all of those questions on sort of what is the hair on the property, right? What
Right.
liens are out there that one would need to pay off and have an ability to sort out things that I don't care or care less about and things that are really urgent and severe that I have to apply my knowledge to cure right away, right? So that was the
Hmm.
intent, and I think that's how we evolved with time.
It's great to hear you be honest about, the beginnings because first of all, I didn't know that your original vision was to sell the reports on the courthouse steps. I met you probably not long after you started, maybe 2010, when you had already made started making that conversion to and the cohort that I belong to, which are investors buying pools of mortgages or real estate or having to decide on the purchase of something very quickly. It really made sense that when someone like you came along, it shook up the industry because prior to that, like you said, it's very discombobulated. You're relying on law firms or title companies who are used to charging a couple $100 a file and then giving you a report that you then have to go and review on your own and everything like that. It just never really made sense, and that was ripe for you to to really disrupt that industry. And now I would have to say you're one of the premier providers of this type of work because, like you said, the idea is not to have us or my meaning our me or my investment team have to go through and read every title report. The ability for you to have that review done, verify lien position, look at the juniors, what those juniors are, even quantifying that into an Excel file for us. I mean, and then to do so for under $100 a file. I don't know if that's still your charge. I don't know if I'm quoting.
Don't give out the prices. Bill, you're special.
I don't know. I think the inflation maybe have it be a little higher these days, but that was back then, right?
Yeah, I can tell you that we evolved from building a platform that delivers that analytics to capital markets, to people that buy REOs, people that buy loans or MSRs or securitizations for the capital markets, to really underwriting a high volume. That was the next challenge, right?
Right.
So I can certainly disclose things that are public. We work with a lot of government entities and some of the largest banks on the Wall Street. You can probably count them, and we work with all of them.
Yeah.
In essence, I think we own about 65% market share right now on the capital
Wow.
market whole loan transactions. And so, for example, we have a 7-year contract with FDIC, right? So anytime there's a bank failure like Signature or SVB, my firm gets involved and we do pre-sale title diligence. In fact, some of the buyers of those assets, like Signature Bank, was Blackstone, or BlackRock, I should say.
Mm-hmm.
They asked, can you underwrite the whole bank, right? And right now the answer is yes. Before, well, it's a lot of assets, but we are well-oiled machine, right? So for us, 20,000 assets at the time is piece of cake. So we have enough resources, a lot of automation. In my world, I have to automate every little element that is mundane human labor, and then human opinion and review should never be automated.
Right.
And certainly some of the big name government entities are starting to dive into full automation. To me, it's a mistake because I think that there will be errors, and
Yeah.
if you wrap for those errors, I'm talking about some of the well-known programs that are launched already,
Mm-hmm.
right? Public knowledge. Certainly, you need to have a human overlay to make sure that's, the GSEs or other providers of that type of sort of insurance are not on the hook for some of the errors of the automation.
Right. No, absolutely. And I think that I mean, you hit the nail on the head, but as we look to integrate technology and especially the newest form, which is the AI technology that we integrate, whether it's through, whether we're on the origination side or purchasing side in terms of borrower fraud, due diligence. You can do a lot you can automate a lot, but at the end of the day, a human still has to be there to verify. And, and that balance is really important. Being that you really are on the front lines, and this is the Debt Doctor podcast, so we try to deliver as much really kind of real world experience as possible, and I'd love to, you and I have seen so many scenarios, but I'm really interested in hearing, and we're going to come back to what you do, how you're using AI as, to integrate things and what you see the future of our industry. But I'd love to hear maybe some real world stories, something what you're seeing, especially since you were involved in the Signature Bank liquidation, which we bid on and didn't win. BlackRock obviously has bigger pockets than us. Um,
A little bit.
and, but, being that you have been on the front line, really inside these GSEs, at the FDIC, inside the big center banks, you've got some insight that a lot of folks do not have. And obviously, I know you're under an A. You can't give too much detail, but you've got to be seeing trends. You've got to be seeing certain things in the last few years. And we hear stories. It's hard to tell what's hyperbole, what's real. Why haven't, the last time you and I met, which was 9 months ago, 6 months ago on the real estate lowdown, you were scratching your head like there in August of 2024, there should have been failures or something. It's like, what is it that you're seeing that could be an insight that that the rest of the public isn't seeing, or that I'm just not aware of, or whatnot?
Yeah, there's a lot of things, Bill. Let's
Great.
peel the onion, right? So, first off, folks that are investing in debt, you're in the right space, right? So, whoever listens to the podcast, you're in the right space, right? Debt will be growing, and the amount of debt that will be in servicing will be growing as well. Even though there's a lot of consolidation, there's a lot of forces that will create less liquidity, more debt, and more delinquencies as well, as evident by the credit card delinquencies, auto delinquencies, and consumer delinquency loans. Mostly coming from renters, but soon enough it'll hit the homeowners as well.
Interesting.
Yeah, so let's start with bank failures, right? Uh, let's see. So we know that the FDIC fund to go and repossess the banks is now pretty much filled back up by the likes of Citi, JP Morgan, Bank of America, and the rest of the banks that were sort of penalized for Signature and SVB Bank takeover.
Mm-hmm.
That's factor number one. The NCUA, which is FDIC of credit unions, just took over the credit union in New Jersey. That's public knowledge already. And I
Mm-hmm.
can say that most likely, I can confirm or no deny that we'll see more of those type of things as well, right? So on the FDIC front, I do see some of the zombie banks to fail still. They're still suffering from the commercial debt. The problem never went away. A lot of the debt is maturing, and they fumbled for so long, and now they're still in the same type of trouble. Even though I don't see a lot of borrowing from home loan banks, federal home loan banks, which you would see a spike on the expiration of pretty much discount windows. It's stable, but a few zombie banks are still there. Now, if the rates will drop, maybe that'll help them just to float, right?
Mm-hmm.
So if you see a drop by 1% or 1.5%, which everybody speculates on the Wall Street, I think we should see that those banks will get to sort of a break-even scenario. Right now, they're leaking cash.
Let's talk about those zombie banks. Can you just dig a little bit deeper in and explain for our listeners what is a zombie bank? What portion of the banking industry do you think this applies to? Is it centered in a particular type of bank? Could you just give a little more color for that?
Yeah, so from what I see, the community banks that had a significant exposure to office space loans, to multifamily,
Mm-hmm.
fix and flip at the peak, those are the ones that I'm talking about, right? It's not the big banks. Big banks are fine. Wells, Bank of America, JP Morgan, they're fine,
Mm-hmm.
right? I don't see any weaknesses there. One bank is better or worse than the other, but they'll still weather any storm. They have plenty of money to do so. But the community banks and the credit unions that really suffered based on the bad loans, I think we'll see some of those fall out. Is it a big percent? No. In fact, I think if I would expect maybe 5 to 7 bank failures by the end of the year, I think that's probably the right number.
By the end of this year, 2025.
Yeah,
Wow, you heard it there. And this is from an actual industry insider saying you would not be surprised if there were 5 to 700 bank failures this year, and we're already halfway through this year,
yeah.
meaning in the next 6 months.
So
That's
two
like
sides to
15 to 20% of the industry. No?
no, those are small banks. No,
Oh, okay. We were talking about that's 1.5 to 2%. It's actually I'm doing the
yeah,
wrong
exactly.
calculation.
Yeah, yeah, yeah.
I don't know.
Carry one.
Maybe
Um,
10%. I don't know. I don't
yeah,
know.
but for folks that are interested in that topic, you can monitor for bank fails on the FDIC failed list or NCUA credit union failed list.
Right.
So obviously you see the one in New Jersey on the NCUA, and just monitor every Friday after 4 o'clock. Typically, that's the announcement of FDIC. The team is assembled on the spots. They take over the bank. They try to find a buyer from the neighboring banks to cause pretty much no distress in the local communities. And then they announce and convert the site to point to the new bank. So it's very seamless to the public, and certainly all the accounts are insured for $250,000. So if you
Right.
have more, and you have a small bank, what I would do is I would certainly spread the accounts to be under.
Right. And that when you in referring to what it's interesting because we live in a wild west now where the rules only apply until the rules don't apply. Which was Signature and First Republic and Silicon Valley. Those failures, which is now 2 years ago. Can you believe 2 years have gone by since we thought we were entering a banking crisis, and then it kind of
Yeah.
slowed down, and like we're like kind of kicking the can. I don't know if it's just white knuckling it. I don't know how you refer to it, but um the Fed kind of, yeah, they changed the rule about the $250,000 limit when it came to those banks,
Yeah.
because you had a lot of tech bros and guys with $1 million multi-million dollar bank accounts. I mean, it would have been quite a. Now it's interesting to see how the rules are going to now go back and apply again. But I think that there's just no way that the Fed could just bail out every single bank if banks start continue to fail. So you make a good point. The 250 limit's probably going to have to apply to the future failures, right?
Yeah, and from the business perspective, I bank with Bank of America, right? So I picked the big bank, and second one sort of Wells. I picked the two banks, top five, right, to make sure that if the community banks start failing, I don't think it'll touch them. So I don't want any business disruptions from the banking perspective. So that's
Mm-hmm.
certainly my recommendation to everybody who is banking with the smaller banking institutions. But again, it's I don't see a recession, believe it or not.
Hmm.
And just to piggyback to what you said, I expected some banks to fail after the election, right? So they were holding things until the election was over to figure out what's next.
Right.
And in my opinion, if Trump would win the election, which he did, I would expect things to start free falling. Right? If the bank failed, we'll take him over.
Right.
There's a few other things at work, such as Doge. A lot of folks got doged, right?
Mm-hmm.
From the Fannie, Freddie, FDIC, and other institutions. They're running on very skinny mode right now, right? So skeleton crew, a lot of folks took the early pensions and buyouts and what have you, and they need to figure out if they have enough staff to take over another institution.
Very interesting. Yeah. And I guess a lot of the buildup, I mean, the one thing one would say about this kind of lull where we had what we thought was a number of where we had a bunch of banks fail in 23, kind of stepped in, staved off that crisis. And then what you were referring to earlier in the conversation was the big banks ended up getting penalized for that. So the FDIC's fund that came in and made depositors hold from those 2023 failures did pull a lot of money out of the system, and then the major money center banks had to feed back in. So in a way, the fact that there weren't failures for the last 2 years, or there was only a few, there was one or two, a lot each year, each quarter, but that kind of gave a little time to rebuild the coffers. And I do know personally from my own experience that that the FDIC and the NCUA have gone out with RFPs. They've gone out and built outside teams to perform these resolutions, which is the idea of closing a bank on a Friday afternoon and either selling off the assets or the depositors or the assets and the accounts or just some portion thereof to another bank, so that hopefully those depositors will have a place to bank come Monday morning, and that's kind
Yeah,
of the plan, right?
and Bill, just to finish the whole picture, right? And why did we start talking about those things for the Dead Doctor podcast is because the second part is if you want to bid on those assets and win those assets, you really have to know the means of the sale, right? Who is the advisor, right? So Garnet Capital, I believe, is an advisor for NCUA.
Mm-hmm.
The FDIC typically sells through DebtX or Mission. So there's all those advisors that if you're a debt buyer, first you should see Bill for any advice, and second is you really have to register and figure out what is the membership cost. How do you get the listings of the loans that are up for sale? If the FDIC bank failed or FDIC took over the bank that failed, where do you bid or buy those assets,
Right.
right? So you really need to know the ecosystem on how the assets go from FDIC receivership through the pre-sale activity to the secure room where you can see the files and ability to bid, and service, right, those assets as well. So servicing aspect is very important. In many cases, they're requiring you to have a servicer that can handle FHA, VA, or other type of loans.
Yeah, no, you hit the nail on the head there. And there's two periods of resolution. Well, there could be more than that, but in general, there's the resolution weekend. So when a bank or an FD or a credit union gets sold or closed, that's done. Usually, that process is completed on one weekend. And the FDIC, the NCUA, they know it's coming, so they know, like you refer to zombie banks, they have a list of banks that are on the watch list. And then once the decision is finally made that the bank is really insolvent and needs to be resolved and closed, then they call their little black book of other banks or investors who are qualified to show up on resolution weekend. They let them know, hey, this is coming up. And literally, an auction of the assets of that bank, whether it's the depositors and the banking branches, or maybe portfolios that need to be sold off separately, all that gets negotiated on that 48-hour period of a resolution weekend. It's very hard to get into that club, by the way. You have to be a bank, you have to be Blackstone, you have to be, you have to be, it takes a lot to get in there. But what happens is that a lot, you also don't see the dirtiest assets. The real opportunities get traded there because if something's going to get sold at a discount, the FDIC is usually not going to allow that to happen in a huge fashion on that weekend in terms of hard assets. They'll sell stuff that they know doesn't have book value off, but when it comes to real estate assets, they're going to take, if they can't find a formidable bidder at a reasonable price on resolution weekend from one of the banks that's going to buy that bank or those deposits, then that gets set aside. That's under what you mentioned as receivership. The FDIC, the NCUA, their servicers start now managing those loans until some period, could be a month, could be 3 months, 6 months down the road, where DebtX or Newmark or Garnett get a third party advisor to the NCUA or the FDIC, then holds an auction. Now that's again something you need to know about. Like you said, where that's an area that we play in, the secondary market. Even if you know about it, you still got to get qualified, and then you got to know how to bid. So it's not as easy as just signing up for a website.
That's right. So you have to qualify, right?
Yeah.
And you have to know people within the ecosystem. But now, taking it a little bit broader aspect, right? We talked about the bank assets and bank fails as potentially source of product for the debt market, debt market investors. You have vast spending, right? So VA, they floated a few ideas. Now you have about 10,000 VA loans. Veterans are in delinquency. They're not qualified for the new VASP. There's 15,000 behind it, right? 15,000 VA loans behind it. What can you do for the veterans? Maybe Wall Street is better than governments. I don't know. Then you have a 50,000 USDA loans that are now delinquent and going through the foreclosure.
Five
50,000.
zero.
Yes.
50, you hear that? 50,000 USDA loans that are now in default and going through some sort of enforcement or foreclosure.
Yeah. So if you're into farms, if you're into that type of loans, Department of Agriculture loans, right? Those are in default. So there's a potential there. Personally, I don't know what to do with them, but
Right.
somebody who does can certainly bid. Fannie and Freddie, believe it or not, portfolios are relatively clean, right? Even though they have a small uptick, relatively clean.
Right.
Ginnie Mae, that's where
The real
the issues
problems
are,
are.
right? So you are getting to 11% delinquency rates, 90-day plus delinquency. What does that mean? We expect to see some of the sales, some of the auctions. Typically, they're called EBO buyouts, right? So that's the Ginnie Mae pools that folks buy in billions, right? So if you're not in a B club, it's very hard to get
Right.
those loans. But certainly, the debt market is going to be filled with the EBO buyouts, and certainly everybody that I work with is participating in that market. And sort of final note where you played Bill quite a bit, right? It's the Heckham property sales by Housing and Urban Developments. Those are typically with the vacant properties with the borrower who is now deceased, which constitutes the default event on the loan, and therefore heirs don't have any right to redeem the property from the investor or from the HUD. So those are like REO properties. It's
Right.
pretty, easy way to go through the foreclosure. No disputes from the borrower side because there's no borrower, and sort of a straight shot acquisition of the property. And there's a significant amount of those. Yeah.
Yeah, no, you hit the nail on the head there. Ginnie Mae, just as a to come back to that, for those that might be listening that don't know that term, money due, it refers to FHA loans primarily, which is these 97% financing, government-backed mortgages. Those are the Ginnie Mae product. It's what most people use to buy their first home, where you can put a minimal down payment, pay for your closing costs. So all in, maybe you're in for almost, 10% with closing costs unless you get a credit. But it actually allows first-time home buyers with not a lot of cash that government-backed a step to allow them to buy their first and or second home. Where the problem is that, like Alex, like you said, default rates are already double digits in that market. And when you get into the more recent like vintages, the originations of FHA mortgages just in the last 2 to 3 years, you've already got teen level default rates in that category. And those folks, the minute you if you have a relatively new Ginnie Mae mortgage, a new FHA loan where there's not a lot of equity going into that loan only gains equity from years of paying and hopefully some appreciation. So the minute that loan goes into default, that 10 or 15% cohort of Ginnie Mae loans that is not performing is pretty much all guaranteed underwater and needs to either be short sold, foreclosed, or some kind of something else needs to be worked out. So that's a real it's a problem, it's a canary in the coal mine, but it's also an opportunity, like you said. You mentioned EBOs as how those things get sold by Ginny, and yes, I agree with you. Heckams are just to speak about Heckams and that program. That too is an FA program, ironically. So it's like FHA insures the first home, and then FHA insures everyone's last home. Those people that haven't built up, maybe their home is their only equity. They have to draw on that as they age. The Heckham program, I call them the Tom Selleck mortgages. It's an opportunity to live off the equity in your home backed by the federal government, and then HUD eventually pays the bank off and sells those pools of vacant homes with dead, deceased borrowers, now sells those homes off on the secondary market. We play in that. But let's go back to the EBO because that's a great segue into a conversation about your new partners. Rocktop, who is, they were a big player in the EBO space during the last go around, during the tens through, I guess they kind of started to get out of it in the late teens, right? And we ended up buying some of their last pools as they were exiting that space a few years ago. Let's talk about it because that's where they made their mark. You've got some insight there, but let's also kind of use that as a segue to talk about what you guys are doing together, because obviously it's technology oriented. How I mean, you were kind of cutting edge in terms of creating systems to automate these processes before AI even came along. You've been doing this. Do you see I mean, I'm giving you way too many areas to go, but where is it going? What are you doing? How are things going to change? Talk to me about that.
Yeah, so let me start with a little history. Rocktop and me were friends, right? And we was talking about 5 years ago. We started talking at one of the conferences, and I said, "Oh, we're investing in AI." And I said, well, AI, shmai, what is that? You know, it's we're talking about OCR, and they said, no, it's AI. And I started to research a little bit, and I found out that yeah, there's a indeed 5 years ago, a lot of people were looking into it, not investing, just dipping their toe to figure out what AI is. And right now, everybody's doing AI. Now, out of 50,000 startups last year for AI business worldwide, 95% failed the year one. Okay. Just at the conference, I've been at the secondary conference in New York,
Yeah, last week.
MBA secondary. Yeah, boy, everybody's talking AI,
Right.
and to me, okay, AI, especially in the past year and a half, gave such a huge jump in the tech-enabled solutions that it's scary for two reasons. One is for every 100 people in my mind that used to do things by hand, only five will remain employed. That's it. That's how good AI is, right? So you only will have a retention of 5% for people that know their stuff, subject matter experts, right? For people that are doing the job, I would be very worried, and therefore it'll spike the unemployment significantly in the upcoming, 2 to 5 years, just because of the AI headwinds influencing the economy. The accuracy level and the approach evolved so much. It really created a number of things that you can do with AI on a very old and stable industry like mortgage market. So we were, I guess, the first ones to get rated as a fully AI platform. I'm not talking about the widget, right? Widget is OpenAI, or widget is, a bot that you train. No, that's widgets.
Right.
Everybody can build widgets.
Right.
I can build a AI music, or I can draw an AI painting. That's a widget. It's great. I don't think you can make any money with it. But the platform with the AI enabled technologies, not just one. We use seven in my business. Seven AI technologies: machine learning, the OpenAI, natural language processing, regex, computer vision for signatures and notaries, text pattern recognition, geographical zoom-ins, and probably a few that I don't remember. But all of those can be applied for one document. That's the power of AI, and really dirt cheap. So when a few years ago, when Rocktop and I, we looked at each other's technologies and brainstormed, they said, oh, we want that. We're really good with Gen AI, right? We're really good in data mapping, and you're really good in platform. So we merged it all together and called it QC Maven. And my recommendation is certainly for Kate Thompson to jump on this podcast and talk more from his side. But I guess I'm filling in for him and myself right now.
Well, we'll make sure we get Kate on here. I've been meaning to get him cornered at some point. So, but go
So
keep going.
he's sort of my brother on the side of the rock top. So we merged the technologies together and created a few leading products in the industry that help with the with some of the mundane products that nobody even touched before AI. I'll give you an example. Something called Corporate Advanced Recon. So this is the product where between the buyer and the seller says, guys, my servicer advanced $1 million worth of fees to pay for things like property preservation on Hack and Pool, or foreclosure expense or bankruptcy expense for the attorneys, or I did the title policy replacement. All of those fees are called corporate advances. And they are a lump sum that's presented in front of the buyer. Now, buyer, to compensate the seller for those expenses and claim those expenses from FHA, VA, Fannie, Freddie, or USDA, need to do some level of diligence. And the diligence was really old without AI. So you have a loan transaction history, so the dates of the transaction for every payment or invoice. And then you have to make sure that you have a copy of the invoice to verify that the payment was accurate on this date and it qualified to the guidelines of Fannie, Freddie, and FHA. Also, you got to have proofs to make sure that when you do a claim at the end of the cycle of the FHA loan, you have all the right proofs and all the right invoices. You have the utility bills, for example, that you paid for on behalf of the borrower, forced place insurance, etc. Right? So you have all of those, thousands of pages of invoices that you have to marry to loan transaction history. Otherwise, you just say, "Okay, Mr. Seller, I trust you. Here's $1 million," right? And you hope that you can collect that $1 million at the end of the servicing for FHA loan. And what happens is, at the end of the servicing, people would write down, $1,000 per loan of just incompleted files, not having invoices, or not having proofs, or incorrect timelines, max allowable exceeding the attorney fees, and then the FHA would not approve the extra fees that, say, attorney charged for foreclosure. So all of those things were like a black box for a lot of servicers and investors, where it was a trust handshake, right? And it was never accurate. It was the biggest point on the market, pain point on the market, and Rocktop and us solved it, right? So it's now full AI. It's completely matching and saying this amount of money we can prove and we can claim in the future. All AI, no human labor. Before, every servicer had a team of 6 to 9 people. It would take forever. And in fact, people that trade MSRs, mortgage servicing rights, never have enough time to look at all 100% of the population. And therefore, it was only sample. So you're buying, blindly 90% of the MSR pool. So there's a lot of things like that we do with Rocktop that enable future technologies without a human, right? So that's why I say it's very scary to me. The power of AI right now will
Mm-hmm.
replace a lot of human labor. And remember, people said, no, don't worry, AI will not displace. It will displace, it will replace. 5% of people will be employed. Everybody else need to find something else to do.
Wow. And it's easy for those in the um, in our class, let's say, those that have already got some success, a little cushion, maybe they're more entrepreneurial. It's easy to say, well, AI is just really going to be a positive because, those people that lose their job, they'll have basically AI agents that work for them. It's going to make them give them more freedom. But that's just not how the majority of humans live. The majority of humans live, and they're maybe only qualified to do a certain thing. So having AI out there doesn't do any good to the person whose job it is to input stuff in India for you overnight, or read a document, and who that's their job, or putting together a piece of an iPhone or whatever these are. It's a little, that's probably the thing, I guess, that's the most volatile and scary about it. As an owner yourself who employs a lot of people both in this country and out of this country, um, how do you feel about it morally? I mean, just from a moral perspective. I mean, I know I employ people that whose jobs probably won't be necessary in the coming years, and it's something that I think about. How do you, let's just turn off
Yeah.
the business and think about the human aspect. How do you
Yeah.
think about that?
So Bill, besides I'm being selfish, um, so I protect my own family, right? So in my
Right,
book, I want to capture 100% of the market with human-enabled AI. In other words, I keep my staff, I keep my family
right,
employed, safe, and then make sure that my technology enables me to handle more volume, right? So that's how I handle it. That's my game, right?
right.
So every day I come into work and I say, we need to capture more business. I feel bad for people that we win the business from. In fact, today I spoke with the CEO of one of the companies. They still have, hundreds of people on staff. And I asked him, do you actually make money? He says, no, I make payroll. I say, That's I feel bad for you because right now I feel that AI can replace a lot of that manual labor that he's still, you know, trying to work with.
Right.
It's AI is this is the snippet that somebody can cut out from our podcast. AI now is cheaper than offshore,
Wow.
much cheaper than offshore. If you throw offshore labor at the task, AI can do it half the cost.
And accuracy probably, if anything, is better. I mean, one of the difficulties I've always had with going offshore is the ramp up period of teaching someone our business, or
Yeah,
getting having to deal with some of the communication lapses, the different time zones and things like that. You really do hit the nail on the head that if anything, that's an interesting way of looking at it. We know the capitalist way is to go find the cheapest way to produce the product or service that you can. It's the reason why so many jobs went offshore to begin with. Why Apple makes phones in China and Vietnam, why clothes and cars are made in East
exactly.
Asia. It is the nature of our way as business owners. So one has to assume that the inclination is going to be to now move from those offshore positions to AI agents that are sitting in the cloud working for you for more efficiently and cheaper. And so the effect of this is really profound. It really is.
Yeah, now if you look at the market today, with the merger of Mr. Cooper and Rocket, or UWM is launching a bunch of services, or Fannie and Freddie have pilot initiatives. Ginnie Mae is doing the transparency initiative. So everybody's looking at AI one way or the other, and I can tell you that for any mortgage market participant, like originator, let's lender originator, they have at least 4 to 6 groups that are looking at the documents, same document at the same time, right? So you got the group that handles the application, you look at the application, group that does closing, pre-closing, post-sale, securitization, and then servicing and onboarding. And there are 5 groups that I just named looking at the same documents in different times. That doesn't have to happen.
And
AI
and by
will
the way,
do.
none of them do it comprehensively. They're
Yeah,
all they're all humans that are just doing their job, and now you've got one agent or that can do all of those tasks and do it and double check it, and then have a human come in to just verify everything. I mean, it's gonna improve efficiency, but and quality, but it certainly does throw the whole world up in chaos, to be honest with you.
well, which is in essence, we're selfish, right? So it'll grow the debt, and we're investors in the debt, and I'm a servicer
Right.
to that community. So certainly we benefit, but one thing that I'm definitely scared of is the headwinds of AI in terms of the unemployments in our industry, banking
Mm-hmm.
and finance. You already see a lot of the layoffs from refi market is being dead
Mm-hmm.
or flat.
Mm-hmm.
Purchase market is not moving, even with a quarter of a percent or 2%, sorry, or full percent interest rate cut. I don't think you'll see the market move as the housing
No, I
industry
agree.
expects.
I mean,
So
I
so
don't
you'll
think the
see,
problem
yeah,
that you have is that even if the Fed tries to cut rates, the bond market is speaking in another direction. So it may not even have the effect that we want.
yeah,
You could see we could be very much walking into a situation like in the '80s. Well, different reasons, different causes and effects, obviously, but where rates will continue to rise on a retail level just because of obviously the loss of credit rating, etc. Wow, we went around the world here as always, Alex. It is an absolute pleasure to spend an hour with you. We do have to come back and do this again, maybe near the end of this year or the first part of 2026, because today we have predicted huge rise in unemployment because AI is replacing jobs. We've predicted somewhere between 5 to 700 bank failures in this calendar year from a guy who is literally licensed to do this work for the federal government, so has some insight. Any other things that we should keep us up at night?
No, but if you're the debt investor, right? There's a huge hot sale in the summer, about 6,000 assets to bid on. There's Fannie Freddie NPL RPL sales that are scheduled for September. There will be bank sales and services sales probably Q4. So there will be opportunity for people to go and grab the product. So I'm not at all disappointed.
Right.
I think it's going to be a great year. In fact, I can tell you that in the first two quarters, we set the record of revenue. So
Wow.
it tells you
Fantastic.
that it tells you that the product is out there, people are buying, and I think whoever wants to play in this market, certainly you align yourself with Bill because Bill is a wealth of knowledge,
And
right?
Alex.
And hopefully me, and certainly, between you or Bill, me and Bill, we can help a newcomer to this market, guiding through some of the complexities, hair, and things that you typically don't see.
Yeah, no, and I
So just
and I
a little
commend
investment.
you, Alex, because one of the fruits of your labor must be the fact that you really did support up and coming investors in this industry during the last go around. So while, rather than going after JP Morgan, Bank of America, all those big boys first, who are now, by the way, all your client, as you pointed out, you went after guys like myself, Matt Rosen, these young up and comers, guys who were building young firms and then became big players in the industry. And by providing that service and lifting up new investors in the industry and providing a good quality service that enabled us to succeed, that's been obviously a huge part of the win-win success for your organization. So
Win-win is your book, right, Bill?
yeah, you know me, I'm Mr. Win-Win. I got the next one coming out, which is probably more apt for today's conversation. It's called The Storm. So it's about all of what's coming with the obviously technology's role, climate's role, the cost of capital, the change of societal approach to things. That's kind of the next one. It's a little bit more of a darker perspective.
There's always light in those clouds, right?
That's right. That's right. That's right. And one man's misery is another man's opportunity, and that's exactly what I've been saying. We'll keep the pods, keep our eyes open, and we'll work together. And if I'm a doctor, you're like the whole hospital, my friend. So, Alex, it's been great spending an hour. Thanks for joining me, and we'll talk again soon.
Thanks, Bill. Take care.